So are interest rates going to continue to fall, or are we going to see it pause here, maybe go up? In this video, I'm going to go through some live action as to what's happening right now in the mortgage market, interest rate market, what just happened with the CPI report that came out, really just go into what we expect for the rest of this year, and lastly, finish on some serious strategies that buyers can take advantage of right now in today's market to help them save money that they didn't have literally earlier this year. So let's dive right in. When we're going through this on the screen, I wanted to talk about the top 10 economic reports that come into play that can move interest rates. And so there's a lot of things that move rates, especially some of the things with tariffs, a lot of it's inflation. But if we actually rank this and go down the list of what moves rates the most statistically and historically versus the least, we start at the first one, which is the CPI, right? This is the Consumer Price Index. This recently just came out, and it came in a little bit better than expected, but overall, there's still a little bit of concerns with tariffs right now. And so I'm going to get into what we think the Fed is going to do next month in September with interest rates, if they're going to cut or not cut during this video. But CPI is a big one. The second one is the PCE report, personal consumption expenditures. This is the Fed's preferred inflation gauge when we're looking at inflation in our country. Job reports. Last week we had a bad jobs report that came out. Bad jobs report actually means good things for interest rates. It means a weakening economy, right? When we have stronger jobs reports, that actually usually indicates higher rates. So we've had a good inflation report, bad jobs report. We're starting to lean into that wave of lower interest rates. And just to kind of burn through a few of these other ones, Fed meeting and statements, GDP, retail sales, which drives consumer spending, ISM manufacturing, treasury auctions, durable good orders, consumer sentiment. I can go on and on and on, and eventually I'll catch my breath. But the point is, there's a lot that can cause interest rates to move. But the keys right now is inflation, jobs data, tariffs. Those are the three big ones that are moving rates in 2025 as we speak right now. Historical context, if we look here, CPI and the PCE matter the most during high inflationary periods. During recessionary timeframes like the pandemic, the 2008 housing crash, jobs reports were a little bit more important during that period. And so let's go into, I shared this in my last video, but I think this is such an important chart that I wanted to share it again. Inflation moves before interest rates do. So let me say that again. Inflation moves before interest rates move. And if we look at this chart, this goes back to the 1970s. You'll notice that in the blue line, which is inflation in our country, versus the gray bar, which is interest rates for a 30-year mortgage, if we compare that side by side, the blue bar, the blue line goes up first, then the gray goes up, right? So inflation's going up, rates are going up second. Inflation goes up, rates go up second. And then you kind of notice here back in 2020, 2021, 2022, inflation shot up almost up to 8%, and then mortgage rates moved up. If we zoom into this chart and go and stretch this into a little bit closer of a view, just in the last 5 years, inflation really went up in late 21, 2022, and early and around ending in the middle of 2022. And we peaked out in that 8% range for inflation. Mortgage rates took almost a whole year until they started to move, right? 6 months to 9 months before rates started to move. But here's what's interesting. Inflation came down, continues to slowly come down, but mortgage rates are being stubborn, right? We have a bigger gap historically than what we normally do between inflation and rates right now. Eventually, this gap will close, and I'll explain why as we go through this. So the next question would be, well, what is the Fed going to do in the September meeting, right? I just talked about CPI, the inflation data. I just talked about jobs reports. If we look at this chart, this is from the CME group, and you may have to zoom in a little bit. But as of today, when I record this, we're at a 94.4% chance that we are going to see a rate cut of 25 basis points as of today after the CPI report came out, and a 5.6% chance that we stay the same. So the odds are right now by the market, Wall Street investors, that we are going to see that rate cut after all. Now, if you go back just a week ago, August 11th, we were at an 85% chance. So we've seen the market actually get more favorable towards a rate cut just in the last week. If you go back to the same day back in July 11th, so if you go back 1 month, we were only at a 57% chance of a rate cut. And so it's kind of interesting to see that the market has shifted to being very keen on that there will be a rate cut in September, and the mortgage market is already pricing that in. So let's go into the 1-year chart of mortgage rates. If we look at this right now on a screen, this is from August 12th, 2024 to August 12th, 2025 from Mortgage News Daily. It's a great website to track broad interest rates. It doesn't mean this is your interest rate, but this is where the broad market is with 800 credit, primary residence, 25% down, all supporting factors. But if we look here, the highest point in the last 12 months, we were at a 7.2% on the 30-year mortgage. We have seen that this is in 2025. So in January and February 2025, we saw rates in the sevens. We have seen rates now coming down into the mid sixes. So we've almost seen a 1% drop in rates in 2025. A lot of people, nobody's really talking about that too much, but that actually does have serious savings. And we've stretched this out a little bit further over a 5-year chart, and we really focus on where rates peaked in 2023. We had an 8% 30-year fixed rate mortgage back in October of 2023. We are in a descending and falling rate environment if we look at this from a 5-year chart, which is good news. But what can buyers take advantage of today in this market right now? And I wanted to show a couple of real strategies. This is an $800,000 purchase price on the screen. We're putting 20% down. And if we're looking at this in January at a 7.25 rate on an $800,000 single family home, versus today at a 6.5% rate at 20% down on an $800,000 home, the buyer's saving $160 a month. And you may say, well, Mark, that's not a lot of money. Well, the reality is that if we stretch that out over a 5-year window, that's almost $15,000 in interest savings just by rate movement alone. Okay, that helps. It's not a needle mover. Most people are waiting for 5% rates to make that decision. But let me show you a strategy right now that some of our clients have been working on doing, and a great real estate advisor can help with this as well. It doesn't mean it's for every property, but if we look at negotiating seller credits, when we have 44% of real estate contracts in America right now having seller concessions, going in to get credits to help get a lower, more favorable interest rate, this is a strategy that in today's market is possible, where if we can negotiate a 3% credit, 3% of the sales price, which would be 3% of $800, $24,000, use that seller's credit or the seller's money to buy your rate down on a 7-year arm, which means the first 7 years of the mortgage, it would be a fixed interest rate. The market is pricing a premium for adjustable rate mortgages right now. And at a 5.1%, now this client's saving $721 a month on their mortgage and $59,000 in interest over a 5-year period. That's not even the full 7 years, so just in a 5-year window. And I show this because sometimes with clients that have shorter term holds in real estate or believe that within the next 7 years, we will see a 30-year mortgage or a 20-year mortgage under a 5% or around there. This is a great strategy to buy in a buyer's market when there's more inventory, less buyer demand, more homes to pick from, get the credit, negotiate through it and help get a better strategy, lower payment, lower interest, and ask the seller to help contribute for this. So I wanted to share that because this is lifetime strategies that we are helping buyers with in today's market to capitalize and win in 2025 to get a better rate, but a better strategy to overall save as much money as possible when they're going through their home buying process. And so I'll leave this on the screen in the link below. Feel free if you want to schedule a discovery call just to see where you're at in the process. Start getting ready, right? Even if you're 1 year out or 2 years out from buying a home, it's good to start now, to start planning your credit to get the best credit score possible, to get the best rate possible, planning your income to make sure that you're doing things appropriately, getting a budget, and making sure you have enough money saved up for when the time comes. So look forward to being in touch. And if you have any questions, feel free to leave a comment below.